Warm welcome to everybody in the room. We've also probably got actually a good number of folk listening live, and in addition to the live broadcast, we are recording it and we will put it on the website as well, so plenty of chances for people to take in what we've got to say. A couple of housekeeping matters. Bathrooms just through here to the right, just in that little sort of narrow hallway entrance, and obviously if there's an emergency, follow the staff. We'll head downstairs. Most of you will know Graham and myself, and Simon, our head of investor relations, but here we go, moving right along. And last time we did an Investor Day back in November 2022, you will remember Jeremy and Nick and Lisa. Jeremy and Nick from the Capital Markets team, Lisa from Wealth Tech, and Jeremy and Nick will present jointly today. Sarah Minhinnick, who you may recall was with us on the listing side. She's got a really exciting role at the Green Investment Fund, so it gave us an opportunity to change the leadership team around capital markets, which we have. So we've done a bit of shuffling, and Jeremy and Nick will take the lead on that. Lisa, obviously from Wealth Tech, will present, and Anna Scott's new to our team from November 22. So welcome Anna, first time presenting, which is great. Anna's got a strong background in wealth management, capital markets, and banking, both locally and globally, and we're really excited to have her here leading our Smart Shares business. So just getting into the day, well, into the morning really. You'll get a few comments from me first up. As I said, Jeremy and Nick will speak jointly around capital markets, Anna on Smart, and Lisa on Wealth Tech. Graham's going to talk a little bit about our value proposition, and I'll do a wrap up. We'll try and wrap this thing up by about 12:30. We could get a little bit flexible on time if there's questions, so happy to accommodate those. And there will be a sandwich for those that are here. Unfortunately, we can't deliver those down the internet. Right, a few comments from me just to get going. Actually, what I should do is just note the disclosure there, please, because you are going to see some forward-looking stuff, and we're not at all suggesting they are targets. Just a few high-level points. So, we haven't changed our strategy. Our strategy is reasonably straightforward, and you've seen this quoted in sort of all the packs that we've produced. It is all about rounding out our product offering in capital markets, and it is about driving scale and operating efficiencies across the business. So that does include, will certainly include Smart and Wealth Tech, but we're also always driving for an optimal efficiency model inside capital markets as well. We are growing a more integrated business, and you'll see examples of that when we go through the presentation. And we do obviously want to grow this thing together, combine those strengths of the different features of the group, so that we can actually create value for our customers and value for our shareholders. So that strategy is pretty similar to what we've seen before. We haven't changed much. We are getting quite tight on what we're focusing on. We're focusing on what we think are the things that matter, rather than necessarily focusing on a very broad range of things. When I think about the business, I actually think we're well organised across the business, nicely balanced, if you like, and you can start to see that when you look at the way the P&L is starting to shape up. And actually the business has got some long-term structural tailwinds behind it. When we think about capital markets, obviously we're at the bottom of the cycle. Hopefully we're starting to see some green shoots, so that will bode well for that business. And certainly the savings tailwinds that sort of support Smart and Wealth technologies are there for everybody to see. When I think about where we've been since the November 2022 Investor Day, certainly 23 was a tough year. Inflation, as we all know, rates obviously used as the lever. As we start to sort of come through that cycle, when we definitely see, and you'll hear from the guys, some increase in activity, we can start to see that dropping through to the earnings line in the capital markets business quite nicely. But it did put pressure on our trading and clearing activity associated with it through the course of 23. As I said, tide's starting to turn. Corporate activity has actually been quite good in New Zealand in the last few months, and we feel that's probably going to continue, certainly leading into Christmas. The other thing that's changed, which is reasonably material for us, is the new government. The new government is very supportive of growing public markets. We've had close engagement with them since 2022, and that was when they were in opposition. And we developed a package of solutions. So this is about how public markets help New Zealand. And there's a package of ideas, solutions, where it's sort of allowed to focus on capital recycling if the government had the need for that, and we think they do. I think most people here probably think they do too. And then there was also a suite of regulatory reforms that we were proposing. They came from the Capital Markets 2029 work that was released in 2019. They are still relevant for today, and I'd have to say we've had very good reception from the government about progressing those changes. They all won't happen at once, they will probably be progressive, but certainly when you look at the core elements of those, so it's disclosure requirements on listing, it is disclosure requirements, once you are listed, it is climate-related disclosure activities where New Zealand's got sort of further in front of the rest of the world. And when you think about director liabilities, the Law Commission's going to do a review on those as well. So certainly the Minister of Commerce has been particularly supportive. We know other senior ministers are. And we really look forward to continuing to work with MD and FMA and the Minister's offices to try and ensure that stuff goes through. And we feel good about where it's at the moment. So I guess in other parts of the business, when we think about where Smart's got to, then now if you saw the results at the end of October, we're now sitting at 12.9 billion of funds under management, so good growth, continuing in that area. And as you'll hear from Anna today, still plenty to do around optimising the operating model there, and that will probably take a little bit of investment over the next couple of years, but we'll go through all of that. And from a wealth tech point of view, we're actually approaching break-even leading into Christmas. So, when we think about where we've come from, we talked about that at the beginning of the year. You'll hear from Lisa, and Graham can step through the numbers if we need to. We are approaching that threshold right now. And obviously, as soon as we get through that, then the next target will be impact positive, which we can see in our sites at the same time. With respect to the business generally, both Smart and Wealth Tech, we feel are very, very well positioned from a competitive standpoint. Wealth Tech has still got plenty of clients lining up at the front door wanting to get on, and the biggest challenge for the team is actually getting them on quickly. But we've got still a very good growth, probably better now than we've had before. Our business is interconnected. There are a few quite good examples of that. As Smart grows and liquidity grows off the back of the activity, it does feed capital markets. When the futures come on inside the capital markets business, we know Smart's going to be a user of those futures. And more importantly, when Wealth Tech and the work started on this, Wealth Tech can support Smart in its operating model. So there is skills and experience and service and product inside the group that we can benefit by using it amongst ourselves, and we are focused on those. Most people will know this. Sorry, I'm not standing right in the road. Most people will know this. I mean, it's just really to draw your attention to it. And we tried to depict on this page the size of the circles represents the growth, if you like, in revenue, up 58% over that time period from 17 to 24, but also the mix change. And the mix change is quite important as Smart and Wealth Tech scale up, and I guess we've had a period of sort of tougher times, if you like, through the markets. Well, we are getting that mix change. What's going to be interesting is how we level out in that regard. We can see lifting in activity in the markets business, as I said before, nicely positioned for that to drop through to earnings. But as we roll into launching futures and the like, just where the new normal is, we're a little unsure at the moment. We know it's going to be, we know markets is going to grow, but how it grows relative to the other parts of the business is a little, it's up in the air because we've got good growth in those businesses as well. So But I guess the key point out of all of this is we are a stronger business, a more stable business, and a business that will probably be more resilient through economic cycles going forward than we've had in the past. What you'll hear from us today, and this is from the teams, is there's an investment thesis here where markets is actually quite a tightly packaged business. We've got the resources right, we've got the technology right, we don't have big technology improvement projects in front of that business. Most of the cost around the capital markets business is going to be more inflationary driven. And we're at the bottom of the cycle. So in effect, what you've got is a business that should see some lift. If that cycle continues to change, most of that will actually drop through to the bottom line. From a smart point of view, well, I guess the other thing too in capital markets, we will round out that product offering. We do have an opportunity with equity derivatives. We launched Dark. Dark's actually going very well. We're quite pleased, probably more pleased than we might have thought. You'll hear from the guys just how that is serving the community. But when we've launched Dark and we'll launch futures next year, that's going to change the shape of that business, and it will actually flow through to increased activity into the cash market. So we feel the markets business is nicely poised, with this cycle change. Inside there as well, you've got the dairy market. So the guys will talk about where dairy's at, and they will talk about the partnership with NZX and how that's actually grown. We've seen good growth in there, and we think we've got plenty more to go. And obviously the debt market, the theme that you'll hear from the team when we speak to that is it's been very stable, even through quite big movements in economic cycles. The debt issuance and the earnings from that is quite smooth. So that's quite tight and nicely packaged. But our risk management's good, tech's good, as I said. We've got the right people facing outwards. It's more, the cost base is more driven by inflation. With respect to the other two businesses, they're good growth options for us. And they're not just options, they are actually delivering on both of those. So, nicely packaged capital markets business with some opportunity in front of it. Good growth options businesses with smart and wealth tech, positioned nicely, and with some structural tailwinds. So we sort of feel that the outlook in front of the group is actually not too bad. Quite bright in fact. And I guess what we're also seeing is, apart from probably a little bit more investment into the smart area as we improve the operating model, we should see cash and net cash flows grow over the course of the next few years. When we've got net cash growing, you'll hear from the team that net cash will grow before NPAT and EPS grows because of the amortisation focus that we've got in wealth tech. But that will get explained as we go through the pack. But net cash will grow, and I guess that gives us options around DRPs, reducing debt, buying back stock if it's still cheap, and I guess playing around with dividends if we want to do that. But we should have that in front of us. We should have those options in front of us, and you'll hear that from the team today. So I can pause for a couple of questions, but I guess what I'm doing is I'm sort of framing that as an opening sort of set of comments. We can roll straight into Jeremy and Nick, who can present capital markets, and then obviously I'll wrap things up at the end.
Just around the timing for the discussions with government and what they're doing at the moment. How do you set the timing, and then I guess how would you sort of set out the big key wins that you're looking for? Substantial figures and everything.
The government will make the decisions obviously themselves. But there's two buckets. The capital recycling piece, they've obviously got to make some calls how they want to handle that. So that is in their camp. But they know that there are options there, and we're very keen to support them, and we know the market is very keen to support them. On the regulatory piece, we may see some of that soon, and then I suspect what we'll see is other things happen through the course of 25. That's my thought. But certainly some of the things that are important for new activity is probably more sooner rather than down the back.
And just to be clear, what are those sort of things that you're looking for?
PFI is the big one.
PFI is right.
Yeah. But again, I say all of that with fingers and toes crossed and doing all of the work with the MD and FMA and the officials and all the rest of it, it is the government's decision. Anything else? Otherwise I'll hand it to the team. Very good, there's the machine.
Okay. Kia ora tātou. My name is Jeremy Anderson and my current role at NZX is as General Manager of Listings, Information Services and Environmental Markets. And I've been at the NZX for 7.5 years, so this makes this my third NZX Investor Day, so it's good to see some familiar faces in the room. My previous roles have included responsibility for our NZX Agri business, and that's prior to its divestment and our focus back on core as of our 2018-19 strategy. Then I went on to lead and grow the data and insights business, which has now evolved into information services. And I've also previously been responsible for market development and looking after our participant relationships as General Manager of Capital Markets Development. This year we've implemented a change in the structure of the capital markets team, as Mark spoke to, and it's been an opportunity to consolidate and deliver a more integrated business, giving the team a new focus. In June I took over responsibility for listings and our Electricity Authority and Ministry for Environment relationships, and alongside this I've continued my responsibility for information services. So today, alongside Nick, I will talk to our capital markets business. In 2024 we'll drive close to $60 million of revenue, so capital markets continues to remain a critical component of the NZX group. As I'm sure you're all aware, this revenue stream has been subject to economic cycles of the last 2 years. But during this time we've not been sitting on our hands, and today you will hear about what has been and what will be delivered to prepare the business to an upswing in capital markets activity. So, as the listings guy, although IPO activity has been low over recent years due to the economic cycle, listings business performance has continued to maintain a stable revenue line. This growth has been achieved as exchanges as listing venues create value from more than just IPOs. Total market capitalisation, including equity and debt represented by the red line in the chart, is a major revenue driver, contributing approximately $10 million of annual listing fees. This steady growth over time was interrupted by the strong uplift during the 2020-2021 period caused by the COVID response. And looking forward, we expect market capitalisation to continue a stable growth trajectory, barring any major economic disruptions, as the effects of lower interest rates come to fruition. The stack bars in the chart indicate the other key metric that I am responsible for, and that's capital raised and listed, split between equity and debt. And based on the current mix of equity and debt listed, for every $1 billion of capital raised and listed, we generate approximately $380,000 in revenue from primary and secondary listing fees. The stability of the debt market since 2015 has been particularly important. It provides a solid foundation for revenue stability, whilst the equity market tends to be a little lumpier. Growth in the debt market over recent years reflects a broader shift to more diversified portfolios. This is an opportunity that we're leaning into, and particularly as we continue conversations with local and central government treasuries to list more of their debt. The step up in 2015 was largely due to the LGFA's support, and this has set the scene for ongoing engagement with government entities that we are seeing as a long-term feature of our market. Mark has mentioned the macro environment, and with the current economic and political cycle, we're seeing encouraging signs of a similar environment developing as what occurred in the period between 2013 and 15. Further lift in capital raising and listing activity is expected through into 2025 and beyond as markets recover and public market valuations become more competitive. In recent months, we've witnessed several large capital raises, with Auckland Airport and Fletcher Building leading the way. Notably, this access to capital isn't exclusive to large companies. We've seen smaller companies like Blackpearl and Synlait use public markets to help achieve their capital goals. This diversity of activity is encouraging as it reflects the breadth of the market opportunities. An important data point that illustrates the opportunity in front of us is total market capitalisation to GDP, or the Buffett indicator. We know that a less mature economy like New Zealand's has a huge opportunity to increase market cap to GDP through identifying sectors and entity types that are underrepresented on our market. The recent structural change in the team has enabled us to renew our focus and bring fresh perspectives into play. Although we're continuing to build on the origination model implemented in 2020 and aligning our team to reinforce our value proposition for companies looking to list. Our role extends beyond engaging with just issuers. We're focused on the entire ecosystem that bring companies to market. We understand that listing a company involves more than just an exchange. It's a multifaceted process requiring collaboration across advisory, accountancy, legal and investment banking partners. Engaging with these stakeholders is key to ensuring that public listing remains an attractive option for companies. And over the last 6 months, we have engaged with the entire ecosystem to help shape our strategy for the future. The ongoing engagement we've been having has shown the market that NZX plays an important function beyond just being a listing venue. We have recently had the investment bank teams from across town in the building here to contribute to that discussion. Our engagement with the Australasian Investor Relations Association, multiple private equity firms, legal firms and industry associations has meant we are hearing from the coalface what the opportunities and challenges are for listed companies. We have been making headway, as Mark has already spoken to, in reducing the regulatory barriers to listing. This work has generated positive responses with high levels of engagement from the FMA, MB, government officials and ministers in the challenging areas of climate-related disclosures, PFI and director liability. The XRB's recent consultation on extending the timeline for Scope 3 emissions reporting has been well received, and we anticipate further regulatory progress in the coming months. We've shown at previous NZX Investor Days that the addressable market includes around what we believe to be 1,200 companies with revenues exceeding $30 million in New Zealand. This is an indicator of significant potential, and our listings team has actively engaged with these companies over the last 5 years. We will continue to drive an origination program with these companies to ensure public listing remains an option. Alongside this, we've identified other areas where we can foster market liquidity and ultimately drive capital markets revenue. Debt markets, as mentioned, continue to be a reliable opportunity. The stability we've seen in debt-driven revenue, as highlighted in the previous slide, provides a critical revenue stream through economic cycles. We're also seeing more accessibility to retail debt offerings, which now hold an important place in portfolios across a range of investor types. The foreign exempt regime has opened new avenues for growth and market capitalisation by attracting Australian listed companies. Santana Minerals is a prime example as it recently chose a dual listing to increase its profile and liquidity here in New Zealand. With our team's support, Santana ensured adequate liquidity from day one, allowing investors to trade more easily. There are a significant number of companies that could follow a similar pathway. There are several other areas that we see opportunities to list new companies. The top 30 cooperatives alone represent 13% of New Zealand's GDP. This is a clear example of where we can increase market capitalisation to GDP ratio. And of course, as mentioned already, the government is showing plenty of interest in capital recycling to help address infrastructure needs, potentially leading to further market capitalisation growth. Before I hand over to Nick, I just wanted to touch on the growth in our information services business. This business has seen substantial progress, growing from $12 million to $19 million of revenue since 2019. Our strategy over the past 5 years has been to transition from one-off revenues to recurring revenue streams, and this continues to be a focus for the team. But we're also looking at how our information services product strategy and how it can help us achieve our broader capital markets objectives. This year we have launched NZX Global Connect, a new platform that enables easier access to our systems for international participants and investors. By partnering with the global network, we've simplified connectivity, making it easier than ever for international firms to bring flow and to take data from NZX markets. We've also introduced new license types, including a historic data license for high-frequency trading firms. This license allows these firms to backtest their investment strategies using historical tick data from our market. While this is just the beginning, it's an important step that paves the way for innovation, which will ultimately bring more liquidity to our market. Nick will now take over and talk about our cash and derivatives market and how they drive growth in the capital markets, and I will take questions at the conclusion of that, if that's right.
Thanks, Jeremy. By way of introduction, for those who haven't met, Nick Morris, GM Cash and Derivatives. I've had 15 years of capital markets experience across derivatives, banking and economics. So while at NZX, this time has largely been across the derivatives markets, carbon and energy, including the SGX Global Dairy Partnership, EX Carbon Partnership and the GDT joint acquisition. So to start off, I thought we'd go through a look at where we're at with our cash and derivatives markets, more so cash in this case. So many of you will know in this room, it won't be any news, New Zealand's recent economic crunch has impeded secondary market activity in equity and debt. So we've been through what can only be described as an awkward combination of high inflation, high rates and low GDP. Now that OCR and inflation are looking to be more under control, markets are starting to prepare for GDP growth. And with markets being forward-looking, we're seeing an increase in secondary issuance, which is boosting cash volumes. In terms of momentum, when looking at average daily value, coming to the start of the year, we were trading around 100 million a day. This has picked up through the middle of the year to above 140 mil, and over the last 3 months, we're now averaging over 160 mil. So to that end, we've seen a 41% increase in volumes in the last 6 months, and that data's to October 31st on a rolling 6-month basis, and that's on the back of improving conditions. So long term, to give you a bit of a reference point, the average annual value traded in cash has been around 40 billion between 2017 and 2019, so that's sort of pre-COVID era, and 43 billion across the last 5 years, suggesting that we should see volumes normalise towards these levels as conditions improve. And each $1 billion in value traded roughly equates to 210k in additional revenue, but note that that's just trading and clearing fees and excludes all the peripheral elements and fees that we charge for. But I think Jeremy mentioned not sitting on our hands. In the period where conditions were slower, we haven't been doing that. NZX Dark was a major delivery for us earlier in the year, and brought us in line with ASX and other markets for having this midpoint order book platform. So it provides a third venue option for our customers trading NZX somewhere between pure on-screen and pure off-screen, with the goal of attracting wholesale flow to the screen. Since launch, it's resulted in over $1 million worth of price improvement to our customers, and that's because customers match at the midpoint, not at the bid and ask. Improving outcomes for our customers. And for NZX, fees are higher than on-screen but lower than off-screen, so you've kind of got a mix with the market being somewhere between on-screen and off-screen as it functionally serves. So it provides an avenue for wholesale flow to come direct to market, and interestingly, retail flow has also been sweeping the book, which sees higher fees generated from that part of the market. So overall, Dark has been good for customers and good for the exchange, and it's got some real momentum behind it as a third venue. But alongside NZX Dark, we've also been building out our wider markets infrastructure to enable liquidity growth. That includes wider connectivity initiatives. So Jeremy mentioned adding a Sydney point of presence and connectivity through BT Radiance, allowing more globals to connect to us more easily, and clearinghouse improvements. So we transitioned to the Financial Markets Infrastructure Act earlier this year, and that means our clearinghouse can meet the criteria to be a qualifying central counterparty, which lifts us to global standards. And not last but not least, the depository. So we've been developing out our capabilities there, basically to increase efficient custody of NZX securities, make it easier and cheaper for customers to use our platforms. So we are seeing interest coming to market as conditions improve, off a more sound base, and we'll further support this with development initiatives that are currently in progress. So now looking to sort of where we're going. At its core, we're focused on further developing out our platform and opening up distribution. Across cash and derivatives, there are multiple initiatives already underway which will drive activity into our key revenue lines. Index futures are a key component of this. So a liquid index futures contract drives revenue, in particular diversity of revenue in challenging market cycles, and boosts liquidity across the market's value chain. So with help from our Cornerstone group, which is largely real money end users that we formed around this product development, we've designed this as a retail sized product in line with more international market trends and to consolidate liquidity across one contract. The business case includes incentives to market makers and end users to drive liquidity, and if we are successful, it drives a raft of peripheral benefits to NZX and the wider capital markets network. And the size of the market, should it be successful, is large. So break-even lots are around or just above the 200k per annum mark, which represents about 3.8% of underlying value traded, or about $2 billion worth of notional value. And looking across to some other examples, while the ASX SPI futures trades around 2 times the underlying market, the average cash multiples across Australia, Sweden and Poland are around the 1.5 times mark. So as a rough guide, at 50% of underlying, NZX 20 futures revenue is around the 6 mil to 7 mil mark, and at over 1 times underlying market, it's over 10 mil of revenue. And this excludes halo revenue from wholesale data fees and block trade fees as well. So index futures have a range of peripheral benefits. I've mentioned that increases arbitrage trading between derivatives and cash, stock lending and borrow, increases the margin carried at the clearinghouse, and opens up potential for new data revenue lines. But importantly, the development of this product provides a platform for future product launches, derivative product launches. It's been a big and complex piece of work to get the platform ready, but we're nearing the execution phase and are currently on track for internal readiness by March, and are working with onboarding multiple participants. There's also cash market settings work which we're doing. So these are a range of smaller initiatives that have been flagged by the industry to us, and in some cases expected to deliver immediate improvements in value traded at the margin, such as, and these elements are tick sizes, what qualifies as a price setting trade, and what midpoint crossings are reported as on market. So somewhat in the technical detail, but there's a raft of sort of micro initiatives that will support liquidity there as well. Other elements of development include opening distribution, so onboarding new participants. Somewhat touched on that, but we've got global names who are currently working through onboarding with us. We've seen the announcement of CMC Markets more recently, but there's also a range of names coming through the derivatives project. A new global trading vendor who is currently building to NZX to enable derivatives access. Enabling market makers, so this year we approved a lighter market maker status for NZX, which is a market maker designation, and further developing out our liquidity provider scheme, incentive scheme, to attract new types of flow into the market. Policy is a hugely important point behind the scenes that not many will be a witness to other than our participants who we have everyday contact with. But the intention is to streamline participant types and access. We're getting lots of feedback both from onshore and offshore participants about status types and how to make it easier to do business on NZX, which we're listening to, as well as a larger rule set review, just to make sure we're in line with global standards and to streamline access. In addition to that, we're reviewing our licence arrangements in Australia to expand our marketing capability up there. And we can't forget about post-trade and clearing. Having a globally ready clearinghouse and developing our depository to create cost efficiencies is front of mind as well, and that's an ongoing process. So NZX secondary markets have plenty of development to come to build on the platform to support liquidity growth as conditions improve. Turning to dairy now, we're now just over 3 years into our partnership with the Singapore Exchange. Since then, we've tripled clearing members, and volume has nearly doubled, and open interest is close to 150% up. So we're achieving growth at SGX with a broader platform and focused marketing efforts, particularly across Asia. One of the focus areas this year has been the addition of financial players. It's important for the evolution of derivatives markets. So 2 market makers were introduced in April with the aim of building on-screen liquidity around the close. The bid-ask spread has been tightened by from more than $100 to $30 for whole milk powder and $40 for skim milk powder for active contract months. And we're seeing that in light of the amount of financials getting involved in the market, which is currently around 12%. So currently ADV, or average daily volume, is about 2,600 lots a day. There's interesting sort of step change levels that are generally considered in derivatives markets. 5,000 lots a day is generally when you see a large influx of mid-size financial players, and the 10,000 lots a day is really when it opens up to the large players. But we're incrementally already seeing those players being added now with our incentive schemes in place. The size of the prize remains large, and we've had this slide up a few times, but we've got some good company here. 1 times is quite achievable for this contract, 1 times underlying. And if you look at some of the other Singaporean contracts up there, so we've got rubber at 1 times and iron ore at 5 times, we're in quite good company up there on their platform alongside these contracts that have been quite successful, and we're learning a lot as well from how they've developed those contracts. So in terms of revenue from the SGX deal, we share incremental revenue with SGX, a component of which is reliant on margin rates, and volatility and open interest and interest rates can impact that component. Alongside our dairy derivatives partnership with SGX, we have our GDT joint acquisition with European Energy Exchange and Fonterra, and this supports the physical markets which underlie our dairy derivatives contracts. We're underway with our main strategic initiatives in GDT, but the large ones to focus on are increasing sellers and products offered in Europe and the US, and to that end there's been 5 new European and US suppliers added since we went live, and insourcing the core technology to drive cost efficiency and control of the future. So with strategic initiatives underway, GDT's investments will be a cost drag for the upcoming years. However, GDT's underlying profitability remains strong. So to summarise, across capital markets we're focusing on 4 main development areas: participation and product, so building a participant network and platform to enable successful product delivery and improving market trade settings are front of mind for us. Our customers, a renewed and aligned focus on customer alignment across NZX's network of participants as well as end users, and to that end looking to direct buy-side engagement to drive liquidity initiatives and further product development. In our policy and technology, I mentioned those earlier, policy in particular is a big area. Working closely with government on primary market settings for ease of new issuance and breaking down regulatory hurdles to participation through rule refinements and new participant statuses. Also leveraging our partnerships. The partnerships we've undertaken to date have leaned quite heavily on both sides' strengths, and we see them as reasonably successful. Pursuing dairy via the SGX partnership and the GDT arrangement, and expanding our EEX carbon partnership are going to be topics for the years ahead. So while NZX capital market conditions have been constrained in recent years, we've been closely managing our cost base in the business while building out infrastructure to enable our markets to flourish as underlying conditions improve. As the market cycle improves, we have given you some mechanisms to model our key revenue drivers within our capital markets business. There's more work in front of us, and a lot of the big deliveries are in flight, but these will further establish the platform for growth and have the potential to make quite a difference to the shape of our market going forward. So that's us, and we'll take any questions.
Just on your dairy derivatives, you've seen lots increase quite significantly this year with the SGX partnership, but obviously your revenue to the end of Q3 was down 20%. Can you just talk about the margin fees and what your expectations are for the year ahead?
Yeah, so we get further clarity on that closer to the end of the year because it's set annually. But if you look at the kind of key positive drivers and the two key drivers, open interest, which has obviously been growing, interest rates on the downside have been contracting. So they're kind of the two ingredients that you look at. Open interest obviously means more collateral held at the clearinghouse, higher good, lower bad, interest rates, yield. So those are the kind of two ingredients. I don't know if Graham, you wanted to add anything to that?
Just to cover it out, I mean the volume's up 15% roughly year to date. The margin fee component, it benefited in 2023 with the interest rate curve being up. In the current year it is slightly lower with it's quite a bit lower because the interest rate curve's changed to be down now. As it flattens out, we'll end up with a flat position that year on year it will start to even out in terms of the impact it has on the revenue. But fundamentally up to now, it's been the volumes has been the main factor. So it's the interaction of those two in the current year that's driving the outcome. We'll talk a wee bit about it later on.
Most negative interest rate environment really helps.
Just around those targets, not targets, but getting to some of those higher levels. So we saw a decent look at the multiples of underlying, they stepped up in 2022 and they sort of, ticked up a bit from there. What drives the next leg to get to 1 times or the 5 times you sort of outlined?
This is for dairy?
For the dairy derivatives, sorry.
Dairy derivatives, yeah. So financialisation of the market is a big component. We've continually got this underlying growth in physical trading and activity as more physicals come on and hedge, and we do have a big supporter in our cornerstone, I guess the cornerstone component behind that market, who is Fonterra, right, the settlement price, and they've only got more and more interested in that market as we've gone forward and more supportive. But financialisation is something we're learning quite a lot from SGX off, how to set incentive schemes, set market maker schemes, and that has been the recipe for which they've grown rubber and iron ore to the multiples they have.
And the market makers came on in April, did I get it correctly?
Yeah, 2. So we kind of had an iteration of it carrying through the back end of last year, but 2 was a bit of a testing period, 1 or 2 dropped out. The 2 ones that are reliable are there now through from April, and they're going steady.
Yeah. Is that sort of key to getting that financialisation going?
Yeah, the screen liquidity.
Yeah.
So often with these commodities markets, it's pushed off screen almost wholesale. So trying to balance that out to improve the growth rate on the way through to attract financials.
Very good. If no other questions for Nick and Jeremy, thanks guys. And I think now we'll hand over to Matt.
Tēnā koutou katoa, ko Anna Scott toko and goa no Smart Owl. I am Anna Scott and I am the CEO of Smart Shares. Well, Smart Shares Limited, the legal entity, and now as per the rebrand, Smart. So a little bit of background about who we are and what that means. It'll be more obvious to you in terms of the New Zealanders, but Smart is a fund manager and it is an independent subsidiary of the NZX, which means that it has a separate board with 2 experienced independent directors. Within the NZX group, we have 100 or close to 100 staff which are dedicated to the Smart business. A number of those are from our corporate services partners, but are dedicated, such as IT or risk and compliance, finance, etc., who spend all their time working in the Smart business. We're a MIS licence holder in New Zealand, so that's a management investment scheme that is regulated by the FMA, and the regulated controls and responsibility that come with that is, as a fund manager, to absolutely protect your investors' best interests. So that is the focus of the business there. As I touched on, as you all know, Smart Shares Limited, which remains the legal entity name, has been rebranded this year to be Smart. And for a rebranding, this is more than just a name and a logo. This, for me, coming in, and I've been in this role for a year now as the CEO, is a chance to review what that strategy and the vision of the business is. But the rebranding obviously gives an opportunity to also reposition that company in terms of what that means to the outside. And that's what I mean when I talk about it's more than just a name and a logo. So it was an opportunity for us to examine our purpose, why we exist, how we want to do things, and where we want to position ourselves. We came up with the tagline, "The Wise Invest Smart," and this is as much about our customer promise and our business proposition in the market as it is about our internal people, our culture, and our common goal in delivering smarter outcomes. So smarter outcomes for our investors, but also for ourselves to be smarter in terms of how we run the business and how we look at that. Yes, it is an aspirational name, but that is part of the goal to then live up to that aspiration. So that is our commitment to improve, to learn, to grow, and to create new product as we go. And that is also our commitment to share that knowledge and information to help Kiwi investors better understand and participate in investing for their futures. And I think that Smart has a unique position, being owned by the NZX, to use that parent company position in the market, credibility, establishment, to leverage that and provide that broader exposure and information to the investing public. So what the Smart rebrand does is it brings together 2 historical brands, the ETFs, Smart Shares, and the Superlife brand, and to combine them to provide some critical mass and momentum, and for customers and investors in the market to realise that that breadth of service provision and funds comes from a single common source. What that also allows us to do is to consolidate those brands and therefore to streamline things like the number of websites and some of those pieces that work behind the scenes to provide that service. The other thing that the Smart umbrella does is provides a common infrastructure backbone across all of our services in the back end of what we are running, and it allows us to provide those services to support others. And in one of those cases, we are supporting the Key Street brand. So we are maintaining the active management philosophy that is in that brand. It retains its own brand presence. But that investment management philosophy and team is supported by our common Smart backbone. And then we get the efficiencies of scale there. 2 separate things at the front end, but the back end is similar and you get synergies out of that. So to summarise, we are at our core a product manufacturer, and that is providing those products to those investors. But what we do need to do in the evolution of our business is to be focused on our customer demands, where our product market fit is, and our product design to make sure that we're manufacturing product that's for the right investors at the right price. I think one of the strengths, I'll help if the slide changes, one of the strengths of our business is the breadth of places that we are in that New Zealand market. So those sub-brands that make up Smart are in the ETF market, KiwiSaver, superannuation, and your unlocked managed funds, and also the active brand of Key Street. That is what makes up our close to $13 billion worth of FUM at the moment. and that is the percentage of the spread where we have our business there. However, in terms of growing from here, we don't want to dilute our growth by trying to be everything to everybody. And if you look at the organic cash flow chart at the bottom, our net organic cash flow over the last 2 years has been impacted by our focus on acquisition integrations. There were some post-acquisition outflows in Key Street, particularly around fixed income and the position of the market environment and the interest rate cycle, but also from minimal marketing and sales activity and that lack of wholesale mandates. What our rebrand will do, will consolidate those brands so that we can have that increased focus on sales, customer service, and product fit to meet that customer demand. And in that space, our sales and marketing activity starts with the ETF product and brand awareness, and then spills from that into KiwiSaver with the intention to grow our market share in that space, alongside the delivery of improved customer tools. For example, a client portal, and we're working with WealthTech on working across the NZ Group to be able to deliver that systems and solutions to our clients. But that growth in KiwiSaver will also drive growth in adjacent areas, such as managed funds, as those investors age and their investment profiles change. Wouldn't be a fund manager without talking about our funds that we do manage. And our core promise there is the product choice, and that's at the heart of our product manufacturing. Over the last 5 years, our range of funds has grown, providing more choice for our investors. You can see across the graphic there where those are spread in terms of tracking those markets, but we also have some more disaggregated views of those markets in terms of alternatives, but also parts of funds covering different markets. How I view these as a bunch of building blocks that provide flexibility and choice. The majority of these building blocks are market and index tracking, which is our job to track that chosen benchmark, but we do also have Key Street, which is under active management and looking to beat that benchmark. Across that spectrum of investors, we're offering everything from the beginning of people's investment journey, which is ready-made packages, and that's using our strategic asset allocation expertise and putting that together in a single diversified fund option. But as that investor comfort or confidence or knowledge grows, some of those investors want to expand their investing horizon. They might have an advisor that they're working with where they want to have more portfolio choice, and our building blocks can be a part of that portfolio. They might be institutional style investors that are looking to have exposure to a particular tactical asset allocation tilt at the point in time, and we want our building blocks to be able to use that to get that exposure, but also all the way through to your DIY people who want to put those ingredients together in their own way for their particular point of view. And I think that our building blocks allow that flexibility and choice. Along with that flexibility and choice becomes that commitment to provide more educational information so that people are, wherever they are in that investing spectrum, getting that desired client outcome, and that outcome is a key priority and driver of our business. For us, being smart or smarter is also going to result in the maturity of our product management life cycle. And by that I mean looking at the number of building blocks that we have, and on a continual basis, like you will see mature product managers and fund managers offshore, look at where the right market fit is for those, where that fee or price value proposition is in the market, where the demand is, what those global themes are, and so that you will have your core set of building blocks at all times, but you may see the side of those, if you want to call them explore, or your other options change over time as you're making sure that you've got the right funds to offer to the right people. Part of that offering of service and maturity of product manufacturing is also leveraging partners, and we have done that, as you will have seen, in the ETF market with our partnership with iShares, to make sure that we're putting our local market knowledge, our local client knowledge, so those local smarts, together with a global partner where we can leverage the depth of their experience in growing ETF markets, but also the breadth of their product offering. In terms of the market, there is an undeniable tailwind in the New Zealand retail investing market, with KiwiSaver being the main driver of that increasing TAM. The FSC KiwiSaver report has stated that KiwiSaver growth in real terms could be between 5 and 900 billion in 2050. And we've also commissioned a piece of research with NMG this year that looked at where that growth in the New Zealand market comes from. And it suggests incontestable FUM across both institutional and retail direct that will grow organically 1.7 times by 2029. That includes investments in ETFs, managed funds, offshore options that are available in New Zealand, and your KiwiSaver market. So how does Smart take advantage of those tailwinds and ensure that our current market position is not only maintained but also improved? And so the funnel here, the components and parameters will be no great surprise to you as analysts, but a little bit of colour here in terms of those external factors that I've talked about in terms of market tailwinds, but also where we want to provide our internal focus, like the growth of the ETF market, and where we are targeting 20 billion FUM by 2029. We combine that volume component with your price, net of fund costs here in terms of thinking about the right product range to meet customer demand, our omni-channel distribution, so that's direct clients to us, but also looking to partner with intermediaries, advisors, online platforms, so that those products get to more investors in the way that best suits them, but also competitive fees and a value proposition. The operating model is both those fund costs that it takes to run those funds, but also the cost of distribution and the cost of service, our client service model. So we are looking to combine, as I said, into one common infrastructure backbone so that we can get those synergies, looking at reducing that cost to serve so that we are less reliant on our people running the engine and we can provide more self-service for our clients. And then those all combine into a platform for strong momentum in earnings. So in summary, very targeted, client-centric, fund-based solutions and products, and an efficient and cost-effective operating model. To get us to there will require some investment, and we've talked about savings that we want to make in the efficiencies of the model and reinvesting them back in for the next 2-year period. That blend of saving and investment means we need to balance the innovation to grow, but also the improvements to maintain our positions. So our improving operating margin into 2027 and beyond is when we will start to see the benefits of that improved operating model leverage, and we are doing that by leveraging external partners, software and service providers to make sure that we do our core common job and we partner with people to deliver the rest of that service. If you were thinking out to 2029, and then you've got an idea of that target FUM at $20 billion. You've also got an idea of net revenue from our half-year results, and a number of you analysed that to what that means at a fund level from EBITDA. We've got improvements to do to make sure that our cost base is effective and productive. In terms of competitive tensions around fees, I believe that those are manageable, and we would do targeted fees reductions to remain competitive in specific products and areas in the market. Key Street remains an active management, as I've talked about, that does bring higher fees in that area on a risk-return basis for investors. Some more detail on where these investments will be required in the next 2 years in order to complete that business change to fulfil our vision. That branding will not only strengthen brand awareness across the business areas, but it does also reduce ongoing support of multiple brands. Customer focus will be on growth in the ETF market via product expansion and number of investors, growing Key Street's market share of the active market, and the retention and acquisition in KiwiSaver. It is the first super life area that will move under our Smart KiwiSaver umbrella. Improving our customer tools for more reach, better scalability, and improved customer experience. And that's for those customers on that journey from the very beginning of awareness through onboarding and into investing. So that includes discovery and information tools at the front end, self-service client portal for administration and transacting with us, and automation and straight-through processing behind the scenes. I've mentioned that product lifecycle management in terms of the right range of funds and checking that on an annual and continual basis to ensure that we are in the right place. But also competitive fees, recognising that there are going to be different value propositions across our product range, but also across our distribution channels, from direct through online platforms, advised clients, and the institutional investment management area. We want to put that on one common infrastructure backbone because that provides investment services to our own investment teams, like the Smart team and the Key Street team, but also those internal synergies give us the benefit of offering that infrastructure to support others in the market by providing that same infrastructure and investment backbone. And last, but by no means least, the people. It's about the right team and the right partners to execute and deliver this together. Happy to answer any questions.
Andrew?
I guess 3 questions. First of all, are you able to just give perhaps a little bit more colour around some of the investments that's going in and what sort of cost out we can sort of see following the investment, particularly thinking about the common backbone, either in absolute terms or perhaps in margin terms?
Yeah, so in terms of margin terms, easier to talk at that level, then our intention is to try and maintain and improve that margin as we go if we can. So we're looking really hard at recycling those savings, and we'd have shorter term savings and putting them back into some of the longer programs.
Second question is just, this sounds very much like a focus on organic growth. In the past we've had a bit of acquisition activity. What's the sort of the current thinking of acquisitions versus organic at the moment?
So I think there is definitely that focus on the organic growth, but in terms of assessing any acquisitions, you never say no to any of those, but that would be really clearly with a view to shareholder returns and cost of capital.
And last question is just around the Key Street side of things and how the funds flow has been going over the last few months, and we're a few weeks away from seeking earn-out and what that's looking like.
Yeah, so that has increased, and as you will be aware, across that earn-out there are multiple components of that. So it's the Key Street funds. We have hosted some funds for Craig's, which are their own strategic asset allocation, and there is also increased flows in the ETFs as we start to talk about the value propositions of those. So we have seen increased flow across all 3 of those areas. The one that has been growing the largest in the last 3 months has been that ETF flow.
So we're seeing.
I'll just add to that. Those flows are in line with the expectations we had at the half year, and the estimate of the earn amount that will be payable in November at the half year is not materially different.
Any questions online?
No.
Anybody? No. Thanks, Anna. Appreciate all of that. And I think we'll now move to Lisa.
Great, thank you. So my name's Lisa Turnbull. I have been leading the Wealth Tech team since about 2017, so right from the beginning of this growth story. Like Jeremy, this was my 3rd Investor Day. So thank you for attending and letting us tell you a bit more about Wealth Tech. 2024 has been a really strong year for Wealth Tech. As at the end of September, we're at 15.6 billion funds under administration. And so this represents a really strong CAGR if you look over the last 5 years, albeit that last bar is only 9 months, so it's actually a 5-year CAGR of 50%. It's actually 4.75 when you do the maths. So the revenue and EBITDA has followed the similar pattern. Revenue 41%, EBITDA 47%, 5-year CAGR. So we're on the path of growth for sure. Our annual recurring revenue is now at 10.5%. This represents a 48% increase for the 9 months to September 2024. So this chart here, I'm trying to give you an idea of the cadence of onboarding, and it really has significantly increased since the early days. The early days we were more focused on building the functionality of the platform, And we're now in a position where when we win a medium-sized advisor, that sort of prospect, the lion's share of the development is behind us. And when we're onboarding them, it's more about the configuration, the training. It's a lot quicker and it's a lot faster to pay back for those onboardings. So adding to the strong wins that we had in terms of new clients in 2023, we've now onboarded 8 full onboardings in 2024. We've put on a further 2 groups that are looking at bringing on new business to start with, and their data migration for the full book is underway. And we've got another 4 advisor groups that are contracted, and there's project execution and planning underway. We now have we restructured the team a little bit during 2023 so that we've got a very streamlined onboarding process. We've created an implementation and support team that's specifically dedicated to that. We've also started, as Anna mentioned, working with Smart. Smart will utilise the WealthTech platform, which will help with our scalability as well as create some operating leverage across the group. So we've got 2 different service offerings in terms of how we take the platform to the market. One is what we call technology only, and that's on your right hand, and that's used by, it's a SaaS service used by the likes of Craig's. The other is where the WealthTech team also undertake the custody and administration services as well as providing the platform. In the last couple of years, we have intentionally focused on winning and onboarding in this custody and administration space because the platform has been ready, and this is where we attract the highest revenue and we will get the most out of terms of scalable leverage. The average basis points has also been increasing in this space, and I guess that's really representative of having a much more diverse range of customers. We're no longer got a small cornerstone customers. We're now out in the market, and the way our fee schedule works in this space, it's very dependent on what the underlying investor is. It's a tiered fee schedule, but it's dependent on the size of the underlying investor portfolios. We are less concerned about growing funds under administration. We've got a real focus on growing our revenue, annual recurring revenue, and maintaining a relatively flat cost base. So as I said, onboarding in that custody and operations space, they're typically smaller advisor firms. Well, they are smaller advisor firms than the large SaaS brokers. However, so their onboardings are a lot quicker, and we would get payback of that onboarding within 1 to 2 years. We have still got a large unnamed SaaS client that we're working with, that we will onboard. And of course, the technology-only clients have the option in the future to get more efficiencies into their business by coming to us for a custody and operation service. Okay, this one here I'm trying to explain a little bit about our assessment of the target addressable market. We now have 45 billion contracted in terms of funds under administration. 15.6 of that we have already onboarded, and the remainder are at various stages of projects and will onboard over 25, 26. So the blue one here, that's what our contracted number is. We assess that the total addressable market is 190 billion, so there's still a lot of headroom there. If we apply the annual growth rate that Anna talked about earlier of 7.7%, that takes our total addressable market over the next 5 years to 275 billion. So of the 16 billion that we've already onboarded, 53% of that we've taken off competitors, and 47 we're replacing legacy systems that are in-house. So we've got those 2 different avenues, and we are making inroads into both. And of course, as you've heard from Anna, and Mark, we are in an industry where we've got really good structural tailwinds driving growth, and coupled with the fact that our proposition is being really well received. We seem to be valued for the modern technology, the customer service focus with credible people who go into these firms and offer solutions and listen, and the fact that we are 100% focused on the New Zealand market, so they know they're going to get attention from us. So, a few more numbers. There's lots of numbers in this pack. As at September, we've onboarded 15.6 billion, as I said, with an annual recurring revenue of 10.5 million. We have a further FUA contracted that will bring us to 45 billion, and associated with this is 17 million worth of annual recurring revenue. As I said, those projects are all underway and they'll onboard over 2026. In addition to the 45 billion, I'm just on the right-hand side there trying to give you a flavour of who we're talking to, or how much of that 190 billion total addressable market we're talking to. We're talking to 17 billion, but to be honest, it can vary widely in terms of how long these take to get to action. But to give you a flavour, 12 billion I would assess at we're in the early phase discussion, 5 billion we're in a more formal process with them, and 1.2 we're awaiting a decision. So what this slide is demonstrating is there is still a lot of headroom and still a lot of capacity for us to grow. So we've given you a bit of a picture of growth to date and what we have contracted. This shows a bit of a, what are your words, Mark? Not a target. Is that the words? It's a forward view as we see it. But a lot of it is pretty certain. So the 5-year CAGR on that blue line, that's our revenue to the end of September with a projection to the end of the year. That's the 41% CAGR. If we onboard, or when we onboard, the contracted clients over 2025 to 2026, that will give us a 2-year CAGR of 39%, so same strong growth. Then we've shown some scenarios here. So if you take that revenue and assume a high scenario of 20% CAGR, that's the yellow line out through 26 to 29. We've shown 3 scenarios. The middle one there is 14% CAGR and the last 8%. Just noting that that 8% would require very little, if any, of new onboardings because that is likely the long-term growth rate. With this revenue picture, we're also demonstrating a likely cash flow. So with the current onboarding cadence, we expect to be cash flow late 2024. The group has made the decision. I have 6 sprint teams focused on the business. Most of them are focused on onboarding new business. The group has made the decision to retain 2 sprint teams for the benefit of Smart. This makes sense from a group perspective as it keeps margin within the group. So we'll be focusing, as Anna said, we'll be focusing on building the tools needed to unlock leverage for Smart and enable them to scale. I think you mentioned one of the big things will be enhancing our investor portal to enable self-service tools. This then has the added benefit of WealthTech's platform being able to be commercialised and taken to the wider KiwiSaver market. When the tools for Smart are complete and we have onboarded, we also have the option to reduce resources and costs unless we've won other opportunities. So we're showing here cash flow positive from a WealthTech perspective. The group has decided to keep 2 sprint teams, the cost of which will be borne by Smart. Group benefits include Smart gaining operation efficiencies, no margin leaving the group, which creates efficiencies within the group, and WealthTech's platform being enhanced so that we can take it to the wider KiwiSaver market once Smart is onboarded. So then a bit about our CapEx cost and amortisation costs. This graph shows both past and projected costs, and it's based on that midpoint 14% growth scenario. So given the phase we're at in terms of start-up and growth journey, we have been experiencing higher CapEx than amortisation. We expect this to switch when we've onboarded the contracted pipeline in 2026. At that point, we will be, based on the 14% scenario, we can release some resources to get that medium growth assumption. At that point, the light blue lines you'll see there, that we'll be experiencing an amortisation bubble. So we will be generating more free cash flow than EBITDA during that period. Of course, I think we've noted there that, of course, this is based on the 14% CAGR medium case. If we win more business than the 14% CAGR assumes, then each of those business cases will be assessed and in terms of revenue and costs to onboard, and may make different decisions than that profile suggests. So the key messages today for WealthTech are: we've experienced strong growth. Our clients and prospects are responding well to the platform and the service offering. Over the last 2 years, our cadence of onboarding has increased, and we expect this will continue. We're in a position where, for the standard advisor business, we have the functionality they need, so the onboarding is much quicker than a couple of years ago, meaning lower cost to onboard and quicker revenue earning and payback. We have a very strong focus on profitable growth and ARR rather than FUA. This will build a more valuable business in the long term. And the pipeline is strong. There's a large target addressable market. We've got structural tailwinds, and we're well positioned. So even with the 45 billion, we're at 24% of the TAM that we've assessed. So there's a heap of headroom for us to go after. Happy to take questions. Thank you. Kieran.
Just a few from me. In your $45 billion contracted revenue, what proportion of that is smart? And
Yes.
I guess the same question for the ARR target of 17. What will the contracted ARR of 17 billion as well?
Yeah. So the 45 billion FUA, all of Smart is in that number. We would expect to be able to onboard all of Smart over the next couple of years. In terms of revenue, I haven't got that number off the top of my head.
But Smart's obviously within that 17 million.
Absolutely.
So that's just going to be intercompany.
Yep.
Yeah.
It's intercompany, however, it's staying within the group, right?
Just to be clear,
Yeah.
Anna talked about synergies earlier on, so yes, it's in the group, but it's not being paid externally by Smart. So let's be clear, you're creating a synergy by doing that.
Yeah, margin's not
From an
leaving.
overall perspective, it's important to know.
Just sorry, Kieran, to follow up on that part.
You would have stayed
So is
up.
that already someone for one? Is that what you're saying effectively? This is including revenue before avoiding that same level of cost elsewhere?
In terms of the group numbers, there will be a intergroup elimination. From a group perspective, we are better off by Smart using WealthTech. Yeah.
It's not paying a cash away.
Yeah.
And then you talk about WealthTech being or delivering cash flow positive, but does that include the allocation of corporate overheads relating to Smart, or is that just the division?
No,
way you report
all direct costs that are related to WealthTech are included in there. The centralised costs relate to finance, legal, HR, CEO aren't included in that analysis.
But importantly, all of the IT costs.
But to be clear, it's a standalone business from an IT perspective. It would only be operationally desktops that would have an element of cost. And that is the case also with Smart.
You could also say, from a risk management point of view, that standalone probably leans on the corporate office for finance and sort of management support. So I guess if you were thinking about it from under the umbrella, or if you took it external, we're applying everything you would apply.
And then I guess just in terms of the CapEx profile, I mean, I know some of those charts are only indicative, but you would expect CapEx for that division to approximately half by FY27? Is that
Again, it's if there's more migrations, then the answer to your question will be no, but that's a good answer because that means we're heading towards more ARR. So it's not quite as one-dimensional as saying yes to your question. If the mid-case scenario occurred and we have no more new clients, then potentially it's more, once those clients in 25, 26 are migrated, then you start to assess the migration resources that you need, which would result in dropping potentially. But the key point of Lisa's presentation is there's a higher target addressable market. We are talking to more people. It is likely we will have more migrations. Hence, that graph is only indicative.
And just a quick question, just thinking about should you be above that 14% growth rate and looking to spend more capex as a result, should we think about the return on that incremental capex to be higher than what's already factored in the existing base? I'm just thinking how do you effectively price that becoming fuller?
Well, we tend to think in ARR terms rather than FUA terms, but in general, the new clients that are small and medium-sized investors that we have won, the capex level is on a 1 to 2 year payback in terms of ARR. It's the large SaaS clients that are more complicated that take a longer time where the payback period can be 5+ years. That's basically what we're seeing. So, the economic decision to continue the capex, not to increase it, so it's not dropping off per that indicative graph. It's more, so we wouldn't expect to jump up higher than what we show there as a peak. That decision is based on that economic, effectively a DCF payback period analysis that it's making economic sense for us to continue the capex.
There is the lever of charge book as well. As we get more clients, when clients want something enhanced, then they're happy to pay as a development charge on that. So that is starting to turn into a meaningful revenue number.
Is there a certain scale within the wealth tech business that you're targeting to maybe make it saleable, or are you at this stage preparing to keep it in the group long term?
We haven't had a strategic discussion on that from a board perspective. I think at the end of the day, it's maximising value is our objective, and whether that leads to inside or outside the group, that's for later to determine.
I think the other thing we see here, a real opportunity for the business, if you like, externally, and also to support Smart. That's where the focus goes right now. You don't say all options are off the table. You don't say but the focus is growth.
Looking at some of the targets that have been set in the past, we get to say things have taken a little bit longer probably than what you would have hoped. So we've got the contracted side of things, so we should feel pretty confident about that. Is there any risk, particularly on the revenue number, I assume that's all locked in. Is there much risk around the onboarding time frame? Would that slip into 28? What are the risks around that?
There are always risks. In terms of as I mentioned, the smaller onboardings, we have a lot more control over. And they are pretty much, if we choose an onboarding target, and as you see, we've done 8 this year, we've got pretty streamlined at those. The bigger onboarding, so you've got the big SaaS, one big SaaS client in that number, which, bearing in mind, they have lower marginal revenue as a result of coming on. That's the challenge, that we need to fit in with clients' preferences and how they want to put efficiencies into their business and what their own priorities are. So there is that risk, but it's going very, very well. We're in a phase of, can I give a bit of a flavour, in a phase of UAT with that client. It doesn't mean that we're going to UAT and we push the button and everything comes, but we're going through UAT at the moment and gone through first phase, no issues. So I can't, there's always execution risk, there's always external parties, and to be honest, in that smaller advisor or medium advisor, they're not small, they're medium, you've also got competitor playing ball. and we've taken quite a bit off one competitor, and we've got a really good streamlined process. We're starting on the other competitor, really. We've got one going live early next year, which will be our first significant one from that competitor. And so we've got that to work through as well, to get the information and make them not run interference with us. So what's in our control, I feel very confident about. What's outside of our control, we have some pretty good mitigating strategies to make it happen.
And in terms of the smart movement that funds across, I presume there's a product development element that you're going through as well, so there's presumably some execution risk around
Absolutely.
putting those time frames on that as well.
Yes, absolutely, but we've got a very good customer in that one. And you know, it's within the group. It's an ideal situation where we know if we have to make some trade-offs because you know we've got a minimum viable product and they'll trust us to come back and backfill it. But you want to hit those timelines, then you know, as between Anna and I, we can make it work happen.
Can you talk about any discussions you've had with Hobson Wild or JB Ware just post those transactions, and I guess what their level of fill is on the platform and what the expectations are that are factored into your contracted revenue?
I think I can talk to 1 or 2 points about that, and very confident on this one. With the JB Ware one, we've only got a small piece of their business on the platform, and it's a very specific element of their business. We look after their pit pipe, and we actually run the administration for them as well. There's been no indication that they want to do anything different with that. Typically when you go through a migration, which I guess that might have been about 3 years ago, we took that on. You know, if it's working, it's a big undertaking, as you know, to do a migration, and I think it is working well. So I'm not nervous about that. Hobson, I mean, Fullbar are still using our platform for services because they have not undertaken a data migration to their existing platform. And we have a contract that is in place for a while. Don't know if I can say any more than that.
I think that's all we can really say, but you know, we factor anything we think would happen into what we projected there for the mid-case.
That's a good point. That is factored in.
And just on the pipeline that you talked to, which was great, thank you. Can you maybe talk about how much of the funnel ends up getting to the bottom of the funnel, like the sort of win rate you've had historically?
I don't have numbers, but I can give you a flavour. I mean, in that medium advisor market, I can honestly only think of, in the last, 7 years, a couple that I think we should have won and haven't, and that they haven't been big. So in terms of when an advisor group has the impetus and the will and the want to move, and to be honest, in that environment, what I'm seeing in the competitor space, it's either because the platform has way better technology and the other providers aren't investing, or the service is way better and the other provider is not focused on New Zealand and is not giving the quality of service required. Also, that other provider is in the process of bringing a new platform into New Zealand, so these groups are faced with a migration anyway, so it becomes a contestable position. And we're doing really well. We've got a team that has been in this industry, a number of us, 30 plus years, so we've got lots of experience, and we've got a sort of, to do this thing, you need some grey hair for the experience, but you need some young people for the startup and the energy, and we've got a really good mix. Don't worry, don't say which one I am, please.
Any more questions? Just anything online, just to double check? No. Excellent. Thank you, Lisa.
Thank you.
Nice job. And over to Graham.
Thanks, Lisa. Morning, everyone. I assume everybody knows I'm Graham Law, Chief Financial and Corporate Officer. Before I start, I'll just remind everybody about the important note that was up on slide 2. Important notice was around any forward-looking information not being guidance. Okay, to start, I am going to summarise the drivers of our recent earnings upgrade and talk about the revenue impact on them rather than just the pure metric. As everyone knows, we publish our matrix monthly and our revenue quarterly. And these are the 6 key metrics that we talk about that drive the majority of revenue and feed into the earnings guidance we give. So just to give you a quick overview and flavour of those, using September year-to-date numbers, conscious that October numbers went out at the start of the week, so there is more up-to-date information, which in the first line probably reflects a higher level of capital raised than issued in October, and narrows the gap. But what I've got up here in September year-to-date is that the actual amount raised or issued was behind target, but from a revenue perspective, we were actually probably ahead of the previous year. And previous year, I mean. The reason for that is, of course, the mix. So when I talk in the half-year and full-year presentations, I'm very clear on that equity is of more value to retail debt, to wholesale debt, to funds in terms of the fee schedule. And we're seeing the mix move here more towards equity, and that's having a positive impact from a revenue and earnings perspective. Traded value and cleared, today we've heard about the improvements in it. We seem to be moving through the cycle and starting to see on a quarterly basis higher volumes come through, and that's having a positive impact for us. Dairy derivatives, we touched on it earlier, but volumes are up roughly 15+% year to date, continue to be at that level. The margin reflects a lower level this year because of that interest rate curve, and that's having an outweighing impact with regard to revenue. So it is bringing our revenue down on a year-on-year basis. So the underlying metric is pretty solid, but just that margin fee component is having an adverse impact. Investment services revenue has benefited from the one-off indices revenue that we noted in the half year. It was 960k. When I pull it out, it's slightly below on a year-to-date basis, year-on-year. And then FUA and FUM, global market capitalisation levels have continued to be favourably impacting with FUM and FUA both growing, although noting that, as Lisa has really pointed out, we focus on ARR inside Lisa's business rather than just pure FUA. Additionally, we really have continued to manage the cost well. People who listened to me at the half year will have noted that we expected some inflation in the second half of the year. We do experience it, particularly in IT, but we are continuing to manage the cost well, and that all has contributed into us upping the earnings guidance to the range of 45 to 49 million. But as usual, that is based on the caveats, which is in the small print in note 1, around market and market potential movements. For completeness, I do note that Fonterra moving to the main board won't happen this year and doesn't have any impact on the current year. We are working through all of the matrix as to how we see them landing in 2025, and ultimately we'll issue our earnings guidance for 2025 in February, and that will affect all the recurrent elements. So that's why I pointed out the one-off in information services. Okay, looking at CapEx, and it is largely dominated by wealth tech. The graphs are the half-year graphs. There's nothing new in those. But I just wanted to talk in general about what we see CapEx levels at, so as it feeds into all other aspects that we'll talk about a bit later. But current year CapEx is roughly comparable to 2023 levels. For what we see for 2025 then is the CapEx starting to reduce, largely in the property, plant and equipment area, where we've had fit-outs of property in the last 3 years, some in 2024 relating to the Wellington office where we let go one floor. In prior years it's this facility here in Albany. But that will reduce back to a more normalised level for property, plant and equipment and other software that really reflects the cyclical nature of IT replacement in effect. For Wealth Tech, we've talked about the profile of it before. There is an additional sprint team in the current year to assist with the large SaaS client that we're bringing over. But these are around the top levels that we will see. The business can't really increase the capex beyond the levels that it has in a manageable manner, I think. And we've given you an indicative profile of what that could look like going forward. I would like to hope that actually it lasts longer, the capex, because that means we're bringing on more ARR. Top left is trading, clearing and energy systems. The move in the last few years has been to, rather than seeing peaks of major upgrades, we're now trying to flatten the actual capex spend so that we're constantly up to date on the version of the applicable software, that when the supplier goes to the next generation of that software, we only have the generational move, not an upgrade and a generational move. And they are cyclical, so roughly 8-year cycles. We update the trading clearing system with to the newest generation. So we sort of expect that pattern to continue. And then finally, smarts projects really are, as Anna has articulated, there is the final Key Street integration work which drives some synergies, and there's the maturing of the operations, and as outlined, that's sort of portal, CRM and registry orientated. That work is largely OPEX in nature. There will be some CAPEX associated with it, but I don't see high levels of CAPEX coming through. The higher levels historically have been associated with the acquisitions. But we don't see the acquisitions and the KiwiSaver default being brought on board, but we don't see large levels of capex. There will be some, but not significant levels. Okay, but as we've mentioned in Anna's part of the business, there is a timing lag between that capex and when it actually flows through into net profit, right? So. Just really want to talk through, in terms of direction of travel, guiding you to look at what happens going forward. We've talked today about the operating activities and where we see growth in those parts of the business over the next sort of few years. But for me, I just want to talk about the key impacts that are non-operating activities in nature. So for the smart business, those integration and operational improvements are more OPEX in nature. We will have in the current year roughly the same amount of spend in that area as prior year. For next year it could be slightly higher, depends on the timing of when we do some of the projects, but it could go slightly higher and be there for a couple of years before easing off and dropping down and having a positive impact through to NPAT. For global dairy trade, Nick talked about it. It's got a big, one of its big projects on the go at the moment is the insourcing of its software and updating of its platform. That is expected to occur through to June next year, and that does have, because it's a SaaS service, it does have a drag on their P&L, which will ultimately have a drag on our NPAT for a period. It's got good underlying profitability. Once that comes out, we expect that profitability to go up a bit, and it still has to mature its initiatives with regard to the US and Europe sales and getting more buyers and sellers on board. But we do see a bit of a drag from it over the coming nine or so months from today. Depreciation and amortization, based on that mid-case profile for Lisa and Wealth Tech, you would expect it to continue to increase and then peak in a couple of years' time before starting to ease off. It takes many years for that amortization bubble to work its way through, that the increase in the operating earnings, the rate of increase in the operating earnings is not as great as the rate of increase in the NPAT because of that amortization bubble, and that's one of the key messages from today. And then net interest, our subordinated notes are fixed in nature until June 2028. So effectively what you see is in the short term, as interest rates decline, the interest income we get on our net cash will reduce, so it'll have a sort of slightly drag impact. Based on the current curves, that'll flatten out, and then when we reprice in 28 on the sub-note, then we would hope that interest rates remain low to then, and we reprice at a lower level. Okay. So that's really trying to give you an idea of the delayed impact that we see coming through on NPAT and consequently earnings per share. But cash, on the other hand, comes quicker, essentially. So yes, the operating earnings on the three businesses drive some cash flow. We have talked about Smart's project costs coming through. But when I look down then at investing activities, we are seeing the CapEx start to drop off and reduce, sort of flatten out and then start to reduce over a period of time, subject to the continuation or not of migrations, which, as I've said, it would be a positive thing. The Key Street earn-out for next year, we have an option of whether we fund that with debt or through cash. And then from a financing perspective, then that actually gives us some optionality around do we maybe in the first instance halt the dividend reinvestment plan and then start to in due course think about increasing the dividend. Other options associated with capital, really. For completeness, when I presented half year and full year, I also talk about how the balance sheet has some elements of cash that's non-distributable. I just want to draw people's attention to that, particularly around the clearinghouse risk capital and to a lesser degree the working capital requirements of both the clearinghouse and the Smart Shares business. Moving a bit to the share price movement, and we did this I think up until Monday, and it has gone a bit around today and yesterday as well. So I think the share price really through the year and talking to investors, we sort of see three drivers at the moment. The improving New Zealand interest rate environment sort of almost seen as a precursor to the market cycle becoming more positive. We're also seeing a lot more demand from overseas investors, and our discussions with them, they seem to recognise the inherent value that's in the growth businesses that hopefully we've alluded to today. And then finally, our improving monthly matrix, because they come out on a monthly basis, you sort of see them where they improve. You see it coming through into the share price to some degree. So those that follow them will clearly are following them and then acting on that. But that said, wouldn't be a CFO without saying I continue to believe the sum of the parts is more than the current share price. That should be of no surprise to people who talk to us regularly. So, I just want to put the case for the sum of the parts. As at the end of last month, we were at 136. I think overnight we were about 144, 145. When we did the earnings guidance upgrade, a couple of analysts did update us, and the average price in there was just over the 160 mark. That price the share price at the end of October versus the average of those analyst upgrades was about 18% below. Given our share price jumped overnight in the last few days, it's roughly 10-11% differential at the moment. So yeah, it is closing to a degree towards the analyst expectations. But I do note that those expectations are a bit cautious on wealth tech, and hence probably a lot of questions from them on wealth tech today. But beyond the financial matrix, there's probably a couple of other factors that I think warrant consideration. For markets, we've largely been through it today. The market cycle, the recovery, how quickly it comes. We've deliberately given you some what I'd call sensitivity matrix on what 1 billion of trading means to us in terms of revenue, in terms of the direct consequence, never mind some of the knock-on consequences. And we have talked about the opportunity in dairy in the short to medium term and certainly equities in the more medium to long term. For the Smart business, Anna's outlined the positive impacts of the New Zealand wealth accumulation phase that we're in. For those that maybe a bit more explanation, I tend to compare it to the Australian wealth market. We're 25 years behind. We're in a growth phase. They're mature now. We'll eventually get to that. And I quoted the Financial Services Council, which in real terms said that the market will be 3 to 7 times as big by 2050, and boiled it down to a 2029 number, which gets SmartShare somewhere near that 20 billion mark. But we also have the opportunity to increase our market share, and that will require some marketing spend. I think Anna's been clear. We've been lax on that front relative to peers, and we will look to that at a 2.25% share. KiwiSaver as a default provider, we should be a lot better and can be a lot better. So we see a positive impact there. But I know that being good analysts, you'll go and compare to other entities, and I just caution you on who you compare to because of the wealth accumulation phase versus being in a mature phase. If you are comparing to multiples of other listed fund managers, be cognizant of what their growth profile looks like in a mature market versus the potential we have in a growing market. Then for Wealth Technologies, Lisa's outlined the ARR impact from our current contract clients and the pipeline beyond that. I think we do acknowledge that it has taken Wealth Tech time to get to this point, but this has been a year of delivery on that ARR front, and we are seeing positive cash flows. We're just bubbling on positive cash flows at the moment, so we are seeing them, and we'll have positive cash flows from this business next year. We've talked about the CapEx profile and how it will tail off at some point in the future, depending on the level of new client migrations. Ultimately, these two factors drive the cash flows from Wealth Technologies, which flow into NPAT at a slower rate because of that amortization bubble. So, key thing here for me is that the cash flow generation is actually different to the NPAT generation. It is NPAT accretive. Next year it will become that, and clients coming on board drives that. We've shown that in these numbers, but just be aware of the lag between NPAT and cash. It's a key thing for me. And really, to finalise, I've been through the operating earnings in the current year, as well as the drivers and indication of direction of travel for the future. I've outlined how that direction of travel impacts the net profit and the earnings per share, and the lag between cash flows coming at a quicker rate. And I've given you my views and valuations, some of the parts, which is, as everyone knows, I'm always more than happy to go into detail on. So I'll pause at that point and open the floor up for questions. Stunned silence in the room. Okay, I'll hand back to Mark.
Yeah, no, thank you. So Graham's done quite a nice job of summing up just then, actually, what the business looks like and how we sort of see the future. I guess if I was just to add a couple of things, there's a couple of key matters. Sorry, right. As I said right at the start, capital markets business, tightly run, right number of teams, tech's really solid. We don't have a whole lot of investment that's got to go in there for remediation or anything like that. We are seeing an economic cycle change. Got some new product coming. Some of that new product in time actually could be quite meaningful, as Nick said. If equity futures get to 1 times or even half times, it's actually a meaningful number into the P&L. I actually feel quite good about where that's at, and being at the bottom of the cycle with a government that's actually now supportive of capital markets. Feel pretty pleased about where that's at right now. Then you've got Smart and Wealth Tech, and you've heard, I guess, from everybody about the growth opportunities, the structural tailwinds, the operating leverage improvement, and the interconnected sort of benefits, if you like, that we've got there. So we feel good about the growth opportunity there. Graham's talked about the fact that cash flow will come earlier than EPS growth. And I guess, that gives us some flexibility, with respect to what we actually do with that cash. Obviously, we've got some environmental changes going on, and the team's actually, in pretty jolly good shape, to be perfectly honest. We're not focusing on a very broad range of activities. We're actually being quite narrow in terms of where we're focusing our efforts. So I look at this picture, where we're at, the environment that we're sort of looking into, and actually feel pretty good about how we're positioned. Happy to take questions. Otherwise, I know we've got a sandwich, for those that are in the room behind the seats. And if there are no questions, we'll obviously wrap up. But thanks for coming, really appreciate it, and great to have everybody here. Thank you.